Hi everyone, I'm Lee Pacchia and I'm here with Houman Shadab. He's a professor at New York Law School. Today we're talking about derivatives and regulation. Heavy stuff when you consider that the global market for derivatives is a multiple of global GDP. Really big stuff. Professor, thanks for joining us today.
Thanks for having me.
Okay, so set the stage for us. This is a huge topic. Can you briefly describe the regulatory landscape? What does it look like with respect to derivatives?
Sure. After the financial crisis and after the Dodd-Frank Act was passed, the major push for regulating derivatives was to have them cleared in a central clearinghouse and then have the ones that are able to trade traded on an electronic trading platform, also known as a swaps execution facility.
So the crisis was 4, 5, 6 years ago. Did any of those things come to bear?
It's happening. Right now, U.S. derivative regulators are about 50% in with finalizing the rules that they were required to pass by Dodd-Frank, and they've proposed another 40% or so, and 10% are just that they missed the deadlines there. But a lot has changed, has happened. Lots of derivatives counterparties are starting to clear their trades through clearinghouses. In this past February, trades are starting to trade on these electronic trading platforms as well. So change is happening. More collateral is being used. More trades are sort of being netted out against each other. The landscape looks a lot different than it did 5 and certainly 10 years ago, when even most derivatives trades were brokered and executed over the phone.
Are those changes, in your opinion, enough to avert another financial crisis?
In some ways, they're helping to avoid another financial crisis, and in some ways, they're actually going to make it, I think, more likely, and in some ways, they're just not relevant. The problem with the financial crisis that we had was basically the derivatives that were related to mortgage-backed securities weren't properly managed, weren't properly disclosed, and technically weren't properly collateralized. These reforms actually don't address the heart of that problem, because these reforms still allow for very customized swaps or contracts not to be cleared and not to be traded, and still to be bilateral between two counterparties.
The additional reforms that need to be made in this area, I mean, this is a tricky thing. To what extent does the current political landscape, to what extent is it willing to bear any additional reforms? Are we simply at the limit point, or is there more room that we can run?
I don't think so. I think that there is more room to go. I think that financial regulators, policymakers, legislators are open towards to doing things better, to doing things differently. I think the problem with pinpointing only derivatives is that you're looking at just one slice of the larger pie that is a problem of financial markets or financial reform in general. I think that just trying to regulate derivatives and make them maybe more transparent and look more like futures markets or even stock markets is a problem. What you need to do, I think, is not address the derivatives market per se, but address the broader institutional framework from banks to broker-dealers, and require more transparency and capital on behalf of those institutions, rather than just trying to regulate certain transactions.
We all operate in global financial markets today. How does the United States treatment of this issue, or these issues, square with other countries around the world?
Well, the G20, generally speaking, is all on board with mandatory clearing, trading, additional capital, reporting, disclosure requirements, having regulated trade repositories to try and create some sort of national or even global database of all these different swaps trades and all financial instruments, in fact. But once you get into the details, that's where the devils are, certainly. And the problem here is that U.S. regulation doesn't square with regulation in other countries, and particularly the EU. So, for example, just recently, the Commodity Future Trading Commission just exempted the branches of U.S. firms that operate in Europe from being subject to U.S. law. Why? Because those rules are much more onerous than European rules. In fact, European swaps or derivatives traders, they are trying to avoid now trading with U.S. counterparties because they know they'll be subject to more onerous requirements. That being said, though, the U.S. derivatives regulators are trying to come up with what's called a comparable regulatory framework or mutual recognition, where they go about saying, if your country's rules are about as good as ours, and they're comparable, will allow something called substituted compliance, where as long as the other side of the trade is complying with, let's say, French law or EU law, that's good enough for us, and you don't have to comply with U.S. law.
Do you think that's going to work? I mean, is that a way that you kind of stitch together a global regulatory framework?
It's not only going to work, it definitely is working. I think it's the only real workable solution when different countries are going to have their own approaches, different countries are going to have their own regulations, their own philosophies, all towards the same outcome, towards protecting markets, protecting consumers, and protecting investors. So I think that's the only workable solution, as opposed to trying to get everyone on the same page with respect to every rule and every regulation.
We were talking before, turning back to what's happening on the United States front, you were saying that there are all these crazy dates that are and deadlines that are coming to bear. Just real quick off the top of your head, what are the 2, 3 that should be at the top of everyone's list?
Well, one thing that people need to be concerned about, and they are concerned about, is how much margin uncleared swaps are going to be required to post when they have an uncleared swaps trade. In other words, how much collateral will be required to be posted by parties that use derivatives that are so customized that they can't economically or feasibly be traded on an exchange or cleared through a central counterparty. Now, the estimates of how much collateral this is going to require are everywhere from $1.5 trillion to $10 trillion in essentially cash collateral or high-quality securities. And so market participants are already trying to come up with ways to reduce that collateral burden amongst themselves. There's also issues with commercial end users of derivatives, like airlines or energy companies that use derivatives to hedge the commercial risks that they're exposed to, for example, by floating gas prices or the volatility of gas prices, for example. And those commercial users should also be aware of the rules that may apply to them, because although the general idea is that commercial end users are not subject to these broader reforms and regulations regarding derivatives, there is uncertainty involved, and if you're a large commercial end user, you may fall under the definition of a major swaps participant or other kind of user that is going to be subject to these rules.
Wild stuff. Professor, thanks for getting us up to speed.
Thanks for having me.
If you'd like to see more of the stuff we're working on here at New York Law School, be sure to go check out the YouTube channel, and you can follow the school on Twitter. I'm Lee Pacchia. Thanks for watching.